Hey everyone, Couch Investor back to another video for today. So here are my picks for 2024, my picks from my personal portfolio, because I did make a video 2 days ago about 3 stocks that I do not own that I think will do quite well in 2024. If you haven't watched that, it's going to be in the top right corner. Now, we did this same video 1 year ago. I chose three companies in my portfolio that I thought would outperform the market and then some. Those three companies were Tesla, Amazon, and Mercado Libre. So Tesla year to date, the stock is up 135.4% at the time of making this video. As for Amazon, that stock is up 79.2% year to date, and Mercado Libre is up 93.48% year to date. So quite a great performance for those three stocks, but especially my portfolio as well, since they are in the top 4 in the portfolio. Of course, the majority of my portfolio sits with Tesla. Second place is Amazon. And then you have Mercado Libre and Meta, which Meta has outperformed the market by a lot as well. Now, I want to be clear here. We will not have great years like 2023 each and every year. We've seen this story play out before, right? 2021 was a great year for the market, was a great year for most of our portfolios, especially if you are in growth stocks, in tech stocks. But what happened in 2022? Well, the exact opposite. If you were a holder of growth companies, if you're a holder of tech stocks, you were down quite a lot. Of course, fast forward 2023, great year for the market, great year for the overall market actually. It doesn't really matter if you value, dividend, or growth, the whole market went up, especially in the last couple of weeks, in the anticipation of rate cuts in 2024, signals that inflation has peaked, so the market has gone up. Now, there are a lot of things that can happen in 2024 that can suddenly turn us back to a sort of short-term bear market. Geopolitical issues, inflation goes back up because of certain things that happens around the world. There's also election at the end of 2024. So a lot of things can come into play that can harm your performance for that year. But as you know, most of us are long-term investors. So if we see an opportunity arise, we will take that as an opportunity to add to great companies. Now, I fully expect 2024 to be a good year for most companies because yes, I do expect that we will have rate cuts, and I do think that inflation will come down faster than what most are expecting. And that should definitely help a lot of growth companies, a lot of tech companies as well, and also dividend paying stocks, because now that, well, wherever your money is sitting at, you will probably get less than what you were getting in 2023. Whether you were getting 4%, 5%, things like that, that number will definitely go down as rates will go down as well. And so maybe more money will flow into dividend-paying companies. We've talked about that in the past couple of videos. If you missed that, it's going to be in the top right corner. Now, I'll start with company number 1, and to be honest, it's a no-brainer. It's again my number 1 position in the portfolio. It is Tesla. Now, before we jump into the reasoning behind that, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and do share your 3 picks down in the comments below, or 1 pick or 2 pick. Doesn't really matter. Let me know down in the comments below. If you want to support this channel even further, do check out the link down in the description and in the pinned comment to get a top 10 best stocks to buy now, or go to full.com/couchinvestor. Thank you very much. So a quick overview of Tesla stock right now with regards to valuation, with regards to its 5-year mean. So PE, EV to EBITDA, price to sales, we can see that for PE, we are much lower than the 5-year mean. Of course, this goes back 5 years. So back in 2018, the company is definitely not in the same financial state than it is today. But here you get a bigger picture. If you want the 10-year mean, again, this also doesn't make that much sense. But 3-year mean, the same story here. We are a bit lower, a bit cheaper. That doesn't mean we are extremely cheap because we're still trading at 71.5 times forward PE. But there's a good reason why the market is giving this company and many other strong companies a premium. If you look at EV to EBITDA, we're trading at 40.9 times, price to sales 7.3 times, price to free cash flow, we are more expensive right now. We're going to have a look in a bit why that is. Now, if we look at what the analysts are expecting for Tesla in fiscal year 2024 and fiscal year 2025, we can see why there is a premium on this stock. Sales for fiscal year 2024 are expected to grow 21.6%, with EPS expected to grow close to 25%. As for fiscal year 2025, sales is expected to grow another 23.1%, so reacceleration of growth there again, and EPS as well, reacceleration here, 37.3% year-over-year growth. Now, if we look at Tesla's Q3 earnings report, we can see that yes, this year has been a tough year, let's call it, for Tesla, but the overall auto sector. There's one segment for Tesla that has been doing quite well this year, and that's the energy generation and storage revenue. Although this is just a fraction of Tesla's revenue right now, this continues to increase by 40% or close to 40% year over year. This will quickly become a meaningful chunk of the overall Tesla pie. This is, by the way, also a segment that has higher margins than the auto segment as well. But moving into 2024 and onwards, with interest rates expected to go down, it will become cheaper to finance a car purchase, which means that demand for buying a car should go up, which also means that Tesla will be less inclined to reduce the prices. Now, Tesla can still reduce the prices if they figure out in a manufacturing way, in engineering way, to reduce the cost to build their cars. Which of course brings us to this slide right here. You can clearly see cost of goods sold per vehicle has been decreasing for the last couple of quarters. Now remember, we saw the price to free cash flow metric being more than the 3-year mean, the 5-year mean as well. Well, that's because it has always been a type of a roller coaster when it comes to operating cash flow and free cash flow for Tesla, because it is still a company that is growing quite fast, investing, building new factories around the world, price cuts, high inflation, lockdowns, chip shortages, stuff like that. So that definitely impacts free cash flow. But as Tesla builds its presence around the world, new Megapack factory in China, another factory in Mexico, whenever that will be completed, remains to be seen. Launches a compact car, whenever that will be announced, remains to be seen. Projections, late 2024, beginning 2025. Cybertruck ramping up, Tesla Semi. Let's see if there is some improvement in 2024. Despite it being an $800 billion company, despite it generating billions of dollars in revenue, having high margins, well, for a car company, let's call it, but also extremely high margins when it comes to the energy side of things, it's still early days for Tesla. I'm not even going to talk here about the implications of when FSD will be solved, when FSD will go out of the beta program. Not even going to talk about that. Not even going to talk about the robot, which definitely we're going to get a big update in 2024 as well. But purely talking on what is working for Tesla right now, what is generating them money right now, that's car sales and the energy business. And I do expect 2024 to be a much better year for the automotive industry, which will definitely favor Tesla. And that's why I put it in my 3 picks. And that's why it is the biggest position in my portfolio as well. Not just because it will do well in 2024, but it will do well for the years to come. Then up next, company number 2, my number 2 pick is, of course, yet again, I know it's pretty boring, but let me assure you, the number 3 will not be again Mercado Libre, despite me thinking that it's still an exceptional company that will do well in the long term, but I picked another company. But my number 2 pick is still Amazon for one specific reason. Amazon is like an octopus where its tentacles just spread wider and reach further than ever before, while also becoming extremely profitable. I'll explain. Now, currently, as we've seen, Amazon has had a tremendous 2023. Of course, the stock was down quite a lot, just like Alphabet, just like Meta, stuff like that. So the outperformance of the stock was a given. But the business itself is becoming much better, the underlying business, because the business as a whole has been great for decades. Now, we're getting to a phase where you can see here PE in the next 12 months, 45.9 times, where its 5-year mean was 71.8 times. EV to EBITDA, 14.1 times compared to 19.8 times. Price to sales, 2.6 times, and this is the big one. Price to free cash flow. Suddenly this company has turned the switch. We are now, of course, very close to the 5-year mean, but that's because for the last 2-3 years or so, free cash flow was negative. EPS was negative. Now, we've turned the switch. And this is why you're seeing analyst estimates for a company of $1.58 trillion. You can see the fiscal year estimates. Sales growth will be the same, 11% for fiscal year 24 and 2025. But EPS growth year over year, fiscal year 2024, an increase of close to 30%. Then in fiscal year 2025, an increase of another 33.9%. Why is that? Well, let's have a look at the latest earnings report. Net income has increased 244% year over year. If we look at the segments, in North America, net sales increased 11%, but this segment, as you can clearly see, has become more and more profitable by the quarter. The company has been focusing on, of course, expanding a lot. We've seen rapid expansion, especially during the pandemic, which, of course, in hindsight, they have maybe grown too fast. We've seen plenty of companies make a lot of mistakes during that period. But since then, the company has become much more profitable, as we can see here. And this is talking about the segments that have lower margins than the others, such as advertising, subscription, and AWS. More on that a bit later. If we look at the international segment, that is still unprofitable, but also pretty close to being break-even compared to where we were last year. As we look at AWS, yes, sales growth has been slowing down in the last couple of quarters. We know why. They've been working with their partners to push them through tough times, but this segment is still a very profitable segment for them. Operating income here increased 29% year over year. And as they said in their earnings call, they expect sales revenue to reaccelerate, and they still think that this market is in the early days. As we know, over 90% or close to 90% of global IT spend is still done on-prem. And if you think that 10 years from now, that number will be much lower than 90%, then you can rest assured that a company like AWS, Azure, Google Cloud will benefit from that. And then last two things here. This is the picture. This is what I've been saying for quite a while. If you looked at operating cash flow, you know that this has become much better quarter over quarter. Of course, it took some time until free cash flow, by the way, this is in the trailing 12 months, until free cash flow became positive. And it became positive and then some quite fast, which I truly expect it to continue in 2024 and onwards. Amazon is starting to become a free cash flow generating machine, which will also mean that it will finally be able to buy back its own shares, because it's one of the few big tech companies that has no share buyback program. Now, if we look at the other things in their business, in their ecosystem, subscription services up 14%, advertising services up 26%, and third-party seller services up 20% year over year. Of course, all of those segments here, AWS, advertising, subscription services, third-party seller services, those are the segments, those are the businesses inside of Amazon that are growing faster than the lower margin business. And this is also one of the reasons why you're seeing this company become more and more profitable. It's very simple to understand. Low margin business growing slower, high margin business growing faster. And so the effects on the bottom line are being seen right now. Now, before jumping into the last pick, I do want to mention a company that I do not own, but I think should be mentioned either way, and that's the Walt Disney Company. I do think that the bar is set extremely low for them to outperform in 2024, especially when you will see the year-over-year comparisons. I think they will have an easy year to convince the market that the company is becoming more and more profitable and that the company is becoming a bit more stable. Now, we have already seen some positive effects with free cash flow, more free cash flow already. The expectations for more free cash flow has been seen. And so the dividend is back, which again, you know my opinion on that. I think it's just a nice thing to have, not a must have, but free cash flow increasing, parks still doing well. The rumors of them selling the India business to Reliance will also increase free cash flow. They can pay down their debt as well. So this company is also becoming leaner. So expect reacceleration of growth, top and bottom line. The bar is set quite low. So I do expect that company to outperform. Then moving on to stock number 3, my number 3 pick, and that's a company that also has its bar set pretty low. You know who it is. It is PayPal. We've talked about PayPal for quite a while, and I do still think that this is one of the best risk-reward companies right now in the market. So PayPal stock, it's still down 12.8% year to date. It's trading at a forward PE of just 11.5 times, which again is a bit higher than the 9.4 times it was at the beginning of November, but still quite lower than the 5-year mean. EV to EBITDA, price to sale, all the same story. Price to free cash flow, 21 times compared to 34.6 times. Now, if we look at what the analysts are expecting for fiscal year 2024, sales growth of 8.6% year over year, EPS growth 12.6%. In fiscal year 2025, sales growth of 8.7%, and for EPS, that's another 11.1% growth year over year. Now, of course, these expectations will probably change quite a lot in the next 2 quarters because of the new CEO. Alex Chriss came in, he put down his vision, what he wants to see change. There are now different, let's call it business segments, new leadership team that should push this company back on track. Because remember, we've talked about this plenty of times. You can watch the PayPal videos on this channel, the bull and bear case as well. It's a company that has a lot of valuable assets. But unfortunately, previous management did not manage this company quite well. And I just want to mention 2 things that were said during the latest earnings call that should bring some confidence back. So this is from Alex Chriss. I am in the process of evaluating our most profitable growth priorities and aligning our resources to those priorities. We will become leaner, more efficient, and more effective, driving greater velocity, innovation, and impact for customers. Then added, going forward, PayPal will be focused on generating real profit for the company. I can't emphasize that last statement enough. It is key to how I believe this company should be run. It is how you should expect us to measure our performance. Unprofitable growth is counterproductive to the long-term prospect of this or any other growth-oriented company. Music to my ears, music to most shareholder ears as well. But I say it again and again, now it's time to execute. And so a quarter, 2 quarters from now, we will already have an answer whether or not his vision is working out. If it is, great. If it's not, then maybe time to jump ship. Now, a couple of things we have to focus on in the next 2 quarters, and that's margins. We've talked about that already in the past, but transaction margins has come down quarter after quarter for the last year or 2. But as we can see, this quarter compared to last quarter, we are down just 0.5% compared to being down close to 2% the quarter before that. So yes, the bleeding is slowly but surely stopping, but I do expect the next quarter for it to be closer to 45%, so probably down quarter over quarter again, but everything will be put on what their expectations are for 2024. We also know that active accounts have come down because they're focusing on higher quality, not on higher quantity. I can obviously talk a lot more about PayPal, but I will just be repeating myself over and over again. I've talked about PayPal in the last 2 months or so, a lot on this channel, so please go watch those videos. But I do think that the bar has been set extremely low right now for this company. This is a company that is still buying back close to $5 billion worth of their own shares, generating billions of dollars in free cash flow each and every year. And if the company is becoming leaner, is becoming more profitable, this will definitely mean that it will generate more free cash flow. And if the price stays low, they will be able to buy back more shares, which means that you as a shareholder, your shares will be worth more. And as the company continues to grow and grow, you will outperform as a result of that. Of course, you need some patience. It has been a horrible ride if you've been a shareholder of PayPal for the last couple of years, but I think that going into 2024, it's probably one of the best companies when it comes to risk reward. And so these are my 3 picks from my personal portfolio. If you're going to see my pinned post on X, you'll probably not see PayPal in that because PayPal is not in the core portfolio, it's in the short-term portfolio. Like I said, the next 2 quarters will decide whether or not PayPal enters in the core portfolio. It still is in the trading one right now. But trust me when I say, if it is going into the right direction in a quarter or 2, it will definitely find its spot in my core portfolio. So those are my 3 picks going into 2024 that I do think that will outperform the market by quite a lot. And of course, it's not just for 2024, it's for the years ahead as well. Of course, do share your picks down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.